The wobbliness that we've been seeing over the last couple of days has not been completely resolved yet, so we're just going to take a look at some levels in the S&P that might be critical today on open interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. Hopefully we will not be cut too short today. I am going to be doing Fast Money, but not for the full hour, so I don't have to jump off right before 5 o'clock Eastern time, so we have a little bit more time to work, hopefully. As I look at the markets, I have to say, much of what I've said going along, that remains intact, despite the fact that valuations feel a little bit stretched. But I have a chart up right here, which has the 50, the 100, and the 200-day moving averages on it. And I can tell you from just conversations that I've had with some traders over the course of the last couple of weeks that the 50-day is one of the things that a few of them are looking at, basically suggesting that they would buy dips to the 50, which they would quickly reverse if it happens to violate that. So I think it's kind of important to understand approximately where that is, so that we have, a better sort of perspective on, how much sort of downside risk there is before there's going to be some intermediate folks stepping in to potentially buy off of a potential bounce at that level. That works out to about 658-ish. In SPY, we can do the same thing for, if you're looking at SPX, we can look in there, and that is going to work out to about 65.83 in the cash. And we'll take a look at the Qs as well. So that works out to 589 spot 40 in the Qs. I'm assuming that most people here are not trading the NASDAQ index. There's nothing wrong with trading the NDX. It's actually a product I like a lot for the same reasons that I like SPX. It's cash settled, European, it's clean in that sense. But I recognize that it is not really that popular with self-directed investors just because the size of the contract is so large. So my guess is not many of you are trading that, but it gives us some sense of how much of a pullback we're looking at. So that works out to, just in percentage terms, which is often how I prefer to think about things. It also gives us a sense of how much risk one is taking to be long here, assuming that that's about 2.7%-ish to the downside in the Qs. So I think we should probably also take a quick peek at, I'm going to look at GLD as well, just so we have a sense of that, because that was really a pretty pronounced move. This was one of the things that Mark was talking about yesterday, is that, when he sort of saw a point of intermediate support, that it was down quite precipitously from where gold was trading, and that was just because it had gotten so far extended above the longer-term trend lines. And, I had a little bit of a choppy day today, and, it basically traded flat, but meaningful support doesn't really exist, it looks like, until we get down, well, what does that work out to? Let's see, 342, about another, that's 9%. For gold, that's actually a big mover. Historically, it would be, because gold is not generally such a high volatility asset. But as we've discussed, volatility has been rising pretty sharply in here of late. So we'll just take a look at the 3-month realized and implied volatility. This gives us some perspective. This is sharply higher than it was. And it is something that, is worth keeping an eye on, because as I previously pointed out, one of the things I've seen in other bull markets that have broken was that we saw, an uptick in vol as we hit new highs. Now in commodities, it's a little bit different because there is that element of positive skew, but it is something to keep an eye on. One thing I would also just allow people to think about. I've talked about this before. When people take a risk-balanced approach, where you basically allocate to different portions of your portfolio, not just in terms of percentages, but also in terms of risk. So if something is typically 20 vol, now it's getting up to 30 vol, you might consider paring that position back a little bit, because as a percentage, it's going to start moving your portfolio much more. So if you're saying, okay, well, I'm willing to take a certain amount of volatility contribution from this asset, as its volatility increases, you can look to pair it. And one of the interesting things that happens in a commodity is that if you have this increasing volatility corresponding with an increase in price, you're probably thinking about rebalancing anyway, because it has outperformed other assets and therefore is now representing a disproportionate part. So as you consider how you're going to reallocate, consider not just rebalancing to size, but also rebalancing to risk. So just something to think about with that. You'll forgive me for 1 second because someone is trying to hit me on the side, and I'm just going to quickly revert. It's just so that they know why I'm not getting back to them at the moment. Okay, so with that, let's start taking some questions. Ranjana Gupta says, Guy Adami's final trade on fast money yesterday was Gilead. Would you please provide your thoughts on the company and draw up a trade? Okay, well, let's go through this process together then. What's the first thing we'll do? Well, why don't we just take a look at actually, let's get some trend lines in there as well. See how far we are above the. So it's actually. Yeah, this still looks pretty good actually in terms of the longer term trend lines. We'll take a look at some other technical studies, not mine, but Bloomberg's. See what this has to say, and we'll rank it by the better performing ones. Kind of a mixed bag, it looks like, on these. You can take with that what you will. And then we're going to go and take a look at the things that I tend to care about most, which are upcoming catalysts, volatility, options prices, and the valuation. So on the valuation front, let's just see how it's valued relative to its own history. 14 times forward, which is cheaper than the group, richer than its own recent history, but that isn't necessarily a disaster if we are getting some uptick in expectations. So next year's anticipated top-line growth is just under 4%. Considering that it was flat this year, or that's the forecast, that's a little bit better than 2025. And looking for 861 a share, that should actually tie out to that number we just saw. Yeah, at about 14 times. Adjusted EPS growth in line with the S&P generally, so that's pretty good, especially since you're getting it at a material discount to the S&P. And then on a free cash flow basis, well, let's just call it a $170 billion enterprise value. So free cash flow, well, we'll just round these numbers out. We'll call it 11.6 billion on 170 billion enterprise. 6.8% free cash flow yield. That is also quite solid. So if I was running screens of stocks that I might be thinking of adding to a portfolio in general, this one would not have hit the screen that I typically look for, which all will know that I'm usually looking for companies that are growing the top line a little faster than this one is. But these are reasonable numbers. 4% year-on-year revenue growth, 14 times forward earnings with 7.5% to 8% adjusted EPS growth, and very handsome free cash flow yields. I think that's totally fine, right? It's not in my portfolio, but I would never look at somebody's book and see this thing in it and say, no, that doesn't make any sense to me. I think that is fine. So they're going to be reporting earnings next week on Thursday, it looks. Doesn't typically move a whole lot over the long term, but more recent quarters we've seen slightly sharper moves, implying a 5.25% move one day. But let's just take a look at this so we're going to go -7 to +2. What did I say? It was Thursday, so it's actually +1. So the average, okay. So the average move 4.6%, and that actually is also in line with what we saw the last few quarters. So 4.5% last time, 3.1 and 6. So let's just take a look at the straddle, because that is calculating the one-day event variance, and what we are interested in now is whether that straddle is pretty fairly priced for the types of moves we've seen. 121.5. I'll just use the 121 straddle for our purposes. So we'll call that 390, and yeah, so we'll just pick someplace right in the middle. So we'll go 390 and 330. How's that? So 720. So that's just under 6% implied move. Seems fair. And let's take a look at the longer term structure here. Actually, I'm going to do one other thing here. We're going to just take a look. I mean, because we've seen an uptick in implied vol, I'm definitely more interested in the buy rates and things like that. You guys have probably noticed this of late. So you can sell 3-month implied at 34-ish. We can sell... Oh, no, that's 1 month. Oh, I must have changed my defaults. That normally sets to... Let's go out to 2 months. See what that one looks like. Not quite as juicy. But, yeah, I think this is... this is totally fine. So let's just take a look at some options trades if you don't have it already that you could use to start working your way in. And, based on what we just saw, I think the implied volatilities are fine for a sale, maybe a cash covered put. If you don't already own it, let's have a look. So we'll bring this in here. And what might we do? So if you already own the stock, you're looking to a covered call, I think they're fine to sell. The implied volatility is fair to just a little bit rich. If you don't own the stock and you would like to add it, a cash covered put is probably not a bad way to get into it. And we could look to something like this. I'm just going to... It depends on whether you want to capture a little bit of the upside. I assume one does. But if you do not, and you're saying, okay, well, I want to collect a little bit of premium here and then potentially own it a little bit lower, you could, sell something close to at the money or even slightly in the money. I would look to, make sure that you're still adhering to this whole concept that you're getting equity-like returns for the risk you're taking. So we want an extrinsic rate of return that's at least 1% a month, even though this isn't a super high implied volatility stock. You could do something like the no 120s, for example, as a potential way to work your way in. Or buy the stock if you're looking to scale in. You could buy the stock, sell strangles against it. I think that's a fine strategy. And actually, with the implied volatility where it is, if you wanted to sort of just get some exposure to the immediate upside, but wanted to do something like a call spread risky, that also will work here. Maybe sell the 20 delta strangle. Now there's something, the prices here are they were a little bit wide. You probably saw that when I was working through it. So this is going to be, it's a little imperfect on that front. But, you could end up with a trade that looks a little bit like this. Take advantage of the vol crush. Those wings should come in pretty nicely. Downside is that you get put the stock at 110-ish in this one that I just worked up here. So 9% discount to the current stock price. Different ways to play it. But I think the valuation is fine. It's a little richer than it has been over the course of the last 2 years on average. But the Street's growth forecasts for next year are also a little bit better, top line and bottom line. So you put those two together and you say, okay, well, on a price to forward earnings relative to growth basis, it's probably right around fair. And why might something like that seem attractive in an environment like this? Well, because on a price to forward growth basis, the S&P is not right around its historical fair value. It's well above it. So as it gets harder and harder as you have everything sort of chugging along at these multiples, get folks a little bit uneasy. It gets a little bit harder to find things that really seem compelling as new additions to a portfolio in that kind of an environment. And so something like this, and you can actually also see that in the beta, right? It didn't really get hit that hard as some of these other things were getting chopped up over the course of the last couple of days. All right, so let's move on. Alex V. Netflix dropped on a negative surprise, but they still expect growth. Buy a dip Monday after the dust settles. I like that. You're looking for a 3-day rule. There are two winners, okay, in the space right now. Netflix is one, and in the short form videos area, YouTube is the other. It's hard to believe. I mean, I know that people who follow me will know that Google was part of my acronym. But the revenue, it's not complete. We don't know the exact breakouts, but we can approximate it. If you assigned the same enterprise value to YouTube on a revenue basis that Netflix get, it would be about a half a $1 trillion company. So we're talking about something that's not an inconsiderable portion of. I know this was not a question about YouTube, but I just wanted to point out that, from my perspective, when I think about who's winning these battles, to me, they are YouTube and short form video, Netflix, and actually Amazon. I think, and Amazon's also kind of cheap here. So Netflix isn't cheap, but they're best of breed. I think that Alphabet and Amazon are relatively cheap. But, in the space, in the streaming wars, it's Netflix and everybody else is also ran in sort of the conventional content type of a format. And they're getting into the things that matter, like sports and so on. So is YouTube, actually, for that matter. So, I have a Netflix subscription, I have a Prime Video subscription, and I have a YouTube TV premium, whatever subscription it was. That's actually not that cheap. But it's a great service. And, I have experimented with everything else, and I just don't see it. The only thing about Netflix is that, it's a little bit frustrating, is that it was trading at a much cheaper multiple before. But who's going to take their place, honestly? So, I think give it a few days to shake out. Look for that. Keep an eye on the long-term moving average. I mean, the other interesting thing is that, think about when we talked about Netflix ahead of the pre-Good Friday earnings. You may remember that it was that Thursday after the close. The market was going to be closing Good Friday, and we talked about Netflix at that time. And it hasn't actually moved that much relative to how much the market has moved in that same intervening period. It's not like it's grossly outperformed and its valuation has exploded on a relative basis. So, where are we? Let's see where we close, actually. Just looking at this. So we are on or around, we were looking at what's it up? Like 11, 12% since then? Let's see. This gets us to, let's see what kind of numbers we're at here. Let's call it, again, just use some round numbers. 34 times forward. I mean, very nice free cash flow growth and a dominant position. 35% year-on-year free cash flow growth, 34 times forward. That is, if you're looking at it relative to the S&P, it's definitely, this is more attractive than the S&P on a valuation basis. And it's a utility. So, yeah, I still like it. I think, and actually the good news is, just speaking to Gilead, we were just talking about, does it make sense to consider being short premium to add? When you get into this kind of a situation, you can have sort of higher levels of implied volatility coming out than you might otherwise. Actually, this one still came in pretty hard. There's not a lot of panic in here. I would have said, yeah, this is definitely a good put selling opportunity, but it's actually not. It's not as compelling as I had hoped it might be. Yeah, I mean, we can see right here we've got 2-month implied volatility at 30. And that's, well below, it's actually below the mean. So, maybe to play for, to play bullish going into the end of the year, maybe some call spreads actually. And these options are not as rich as one might have hoped, looking for a potential rebound into year end. But yeah, I still like it. Okay. Yeah, I don't get the Netflix drop. Wasn't the Brazil thing a one-time event? Look, ask yourself this question. Who is competing with Netflix at the same level? And I think kind of the short version to this is nobody, right? Who is going to cancel their Netflix subscription who's watching this right now that has one? I'm guessing nobody. And, the long-term knock on them forever was this whole issue about content and how they were going to have to continue to pay up for content. And, they're doing these non-exclusive deals, and they can do non-exclusive deals because they don't need to hook somebody into their environment by saying, oh, I've got XYZ show or some movie that nobody else has got. People are on Netflix. So when they do a non-exclusive deal, they don't have to pay as much for it, and they get the difference. It's a great business. So, until you start really seeing a knock on, if somebody comes up, I don't even know what the other thing would be. Amazon, like I said, Amazon Prime and YouTube, it seems like every other effort that I've seen, whether it's Paramount Plus, or Disney Plus, all the other streaming services, they're not in the same ballpark. So I would just keep an eye on, is the top line continuing? How does the valuation look to the broad market? Because it's kind of like a utility. It's one of these areas where it only has to be marginally better for me to still like it than if it was in a more speculative business. So are you more comfortable spending 34 times forward earnings for something like Netflix that has more attractive rates of growth than the S&P, or that same multiple for something like NVIDIA on that same growth rate? And, NVIDIA, at the moment, it doesn't seem like the CapEx story is slowing, but we have to acknowledge that circumstance is more volatile. It is possible that something new comes along and changes the game there a little bit. We don't see that in Netflix's case. So all else equal, if I can get something that has free cash flow growth of north of 30% year on year, and I can get it for 32, 33 times forward earnings, with the S&P trading 27 times and growing the bottom line at, call it 7 or 8% free cash flow growth, maybe 10%, NVIDIA's situation is going to be choppier. It's going to be more volatile. And because of that, it doesn't deserve the same turn. So for me, yeah, I still think that the Netflix situation is a good one. I think we've beaten that one up enough. Hi, Mike. As a longtime holder of Oracle, wondering what your thoughts are of the company now that it's given back about half of the bounce in September. Would you consider selling Strangles here? And the short version is yes. I would. Let's take a look at how juicy those are. First of all, see where vol is. We're looking at the white line. Let's go out to 2 months. Let me get rid of the historic. They tend to be a late reporter. So we've got vol in here. Longer term average is 40. It's trading 54 and change. And let's see what we can get. So let's take a look at, basically the range that we've seen over the course of, let's look, maybe the last 3 months. And we'll blow that up. That gets us into the neighborhood of 320 to the upside, 240 to the downside. And oops. There we are. Get something that looks a little bit like that. And we're going to get 16.5 versus 273, 6% over the course of just under 2 months, 3% annualized. Downside risk is that you own the thing at 230. Let's just call it, well, you're collecting 16.5 bucks. So the downside here is that you're going to own it at 224-ish, or you're going to be shorted at 346, 345, 346. I think that works. I mean, you could even probably tighten that up a little bit on the upside if you were so inclined. But yeah, I like the way you're thinking about that one. All right. I used to, but says, is there anything YieldMax can do to improve Alti stock? So for those who do not know, Alti is a diversified collared stock strategy intended to collect, to maximize distributions to the holders of the ETF. It is one of the 55, I lose track sometimes, 55 funds within the YieldMax family of funds. And the 240 some odd or 250 funds or so that are in Title overall. If you don't know, I am YieldMax strategist at Title Financial Group. So I do participate on the daily trading meetings for Alti. Let's take a look at it and see a little bit what it is that he is referring to and how we think about it. So first things first. Actually, let me pull up. If you just look at a price chart of Alti, this is what you see. And you would say, well, that doesn't look so great because the prices of this thing just seem to be going down and down. I mean, fairly flat over this period here. As you can see, it's down a little bit, over the last 6 months or so. But, and by the way, it was paying distributions at a much faster rate. But the thing is, this is not the right way to think about it. Because it pays big distributions, the way you need to think about it is this. And this orange line is effectively what your returns on this fund would have been had you bought it exactly a year ago. And I didn't pick the dates. We can pick any date on this timeline that we choose. We can go further. Well, we can't go that far back because some of these funds are relatively new. But, if you were taking the distributions and reinvesting them, you're up about 20% over the last year, which I think a lot of managers would be reasonably satisfied with results like that. If you had simply taken the distributions and not reinvested them, then you would be up about 14% in total returns, even though the price of the shares are down by 50%. And that is because it has distributed about 65% of its year-ago purchase price. So are there funds that have a more stable share price but also have big distributions? And the short version is yes, this one is more aggressive, but there are others that are less so. Did I put that in right? Nope, that is not the correct one. Big E. This is what we want. So I'm going to put this in. So this one has more modest distributions. It does. I can't go back a year in this case because this was only launched in November. But you know, if you're looking for something that has more stable prices, here the share price is up about 4.7. Total returns if you reinvested 15.7. Total returns if you just took the cash 14.7. And the actual distributions are about 10%. So this thing is paying 1% per month. So you get some appreciation in the underlying asset. And there are others that, you know, have, you know, more, I guess, underlying assets that have performed better than Ultis have. Chippy, for example, is another fund. You know, this is one that is up 23. The share price is up 23.7. The total returns 53% if you reinvest the dividend. Total returns 48.8 if you did not reinvest the dividends. This one's now, as you can see, it's a weekly distributor. But you know, it's not the way you need to look at options strategies generally, where you're selling premium against some basket of underlying assets. Is number one, how do I feel about the underlying assets? If you're because you're going to be long those assets, so you want them to go up in value. If the underlying basket of assets, if you are doing this strategy yourself in your portfolio, or you're asking someone else to do it on your behalf in a single stock, or if you're trying to do it in a diversified basket of stocks, the performance of those underlying assets is going to matter, and that's up to, you know, the individual investor to choose. Like I said, there's 55 funds here, and there are some that have a bullish tilt, some that have a bearish tilt, some of them are sector thematic, and you know that's what you need to do. But I will say this, that if you are using options to generate, whether you're doing it yourself to just give yourself some premium, excellent strategy, a long and time-tested strategy. You know, in situations where the underlying value, so if you sell calls and the stock goes up and then you take all of the premium that you got from the short call and then you do the same thing when the stock goes down, well, and you're selling strikes, you know, ever lower strikes, you're going to be capping some of your upside. If you're always taking the premium out from the short calls, eventually what's going to happen is the value of that account, that portfolio, that fund, whatever it is going to decline. And you can only keep that stable by redeploying some of it, unless you're looking at a strategy that's going to be much less aggressive with respect to the options that it's selling. So in the case of these funds, that's going to be target 12s. In the case of your individual work, ways that you can do that in your own portfolio is, you know, are you trying to maximize the decay, the theta, by using really short-dated options, which will increase the volatility of your portfolio because you're going to be selling really options that are very close to at the money? I think some of you may remember that I showed an example of a long-term buy rate in strategy. If someone had bought strategy at, call it $300 on the first trading day of 2025 and sold at 20% out of the money January 2026 call. So bought it at 300, sold the 360 call. That's a strategy that has materially outperformed the stock. It is a strategy that has materially outperformed short-dated covered call sales. Of course, it's a little bit difficult because you can't take regular distributions out of a strategy like that because you're kind of married to it. Unless you're going to close the position, right? You could, of course, always unwind it, sell your stock, buy back your call, and say, okay, I've taken all the gains I want to here, and I'm just going to monetize it and use it as distribution. Those are the trade-offs that you're going to be dealing with. Now, if you have a circumstance where short-dated implied volatility is high, and you think it's actually overstating how much the stock is going to move around, and you have steep backwardation in the term structure. Let's see if I can come up with an example. Oops. We'll just take a look at the calendar, see what stocks are going to be reporting earnings, see if we can find some that have big chunky. Oops. That's not what we want. We'll look at the Russell. So we'll look for things that are going to be reporting earnings maybe next week. And so I don't know why this is not how my date ranges usually would work. So we'll go like this, 10/22, 2025. And we'll go out to 10/31. Let's see what names in here are likely to have some big moves. Colgate, they're definitely not. There we go. Maybe Ingram. That could be one. We already looked at Gilead. That's not really implying a really big move. Coin, yeah, so coin probably. So let's take a look at the term structure here. And again, this is basically just to discuss what strategy is most interesting under what circumstances. So here's a good example. So if you think that coin is unlikely to be more volatile than it has been in the past going into earnings, you might say to yourself, okay, I want to take advantage of that by selling near-term options on it, knowing that the vol is very high and options decay as a percentage of their own value much more rapidly as expiration approaches. So then you can do something like this. This is ill-suited for circumstances where you think that the stock is going to chop around a lot in the short term, but is probably, that noise is going to overstate how much volatility you have quarter on quarter, year on year. That was one of the reasons why I used strategy, then MicroStrategy, as an example of how sometimes a long-term buy rate can really work out very nicely, because you're saying, look, this thing has been exceptionally volatile, but that volatility is as the underlying assets mature in the marketplace. That means as Bitcoin gets wider adoption, and as the volatility of Bitcoin drops, and as the kinds of structuring that Michael Saylor was doing begin to look more like preferreds rather than, these converts because of that decline in vol, then doing a long-term buy rate might make sense. So when you're looking at these funds or you're doing these things individually, that's what I want you to kind of think about. There's a couple levers there, but all of those things are going to play into it. So, yeah, I don't think that there's anything necessarily wrong with Ulti. Do I wish that we could just have a perfectly stable NAV and that it would behave a lot like a preferred stock where the underlying share price wouldn't move around that much? That would be a lot cleaner. It's also not that realistic. The total returns are still quite good, and it is making decent distributions over the course of time. But there are products that you can buy, including some from YieldMax, that have more price stability in the underlying shares, and there are strategies you can employ in your own accounts that are similarly going to be less choppy than owning the stock and selling weekly call options on that stock or stocks that you hold, and that's what's going on there. Okay. Beyond gapped up and closing lower after a dilutive debt deal last week, what do you think of a small position buying shares and continuously selling weekly calls against it? Well, it's funny. Let's take a look at some of the calls that traded today. Some of these things, was it these 9s? I think it was these I was looking at. These 4s, maybe? Let's take a look. Huge volumes. What was the high in this? Yeah, so these things traded to over $4 at one point today. Closed at 89 cents. All I can say is that if you're going to trade in these things, this is quite the roller coaster you should expect to be on. Beyond So a lot of the stocks that saw unusual options activity today have a circumstance similar to this. These are meme stocks, these are not economically viable companies in the long run necessarily. But people are buying them because they're kind of doing that meme stock trade. This thing, the short interest, as you can see here, 63% of the float, right? It's 40 million share short. So you're basically playing for a squeeze. Is that okay? I suppose. You know, if you buy the stock, by the way, and you sell calls against it, what you are doing is essentially the same thing as selling puts. And, you know, you can ask yourself, well, do I want to do that, or do I just want to sell puts on it week after week? You know, that might be a fine strategy, too, if you're looking to take advantage of this and you're inclined to play. I'm not playing in these things. You know, I have not done that. I'm not about to get started. Though it is tempting from time to time, just because it looks like fun. But that better be how you think of this, because it's not an investment. To illustrate this, let's just take a look at the company's financials. This is what you're looking at right here. Okay, so the thing's basically half debt, half equity, doesn't make money, bleeds cash. In fact, you know, next year's free cash flow is anticipated to be, you know, $70 million negative. So 70% of the company's outstanding cash is gone. So they got to raise money, right? And this is the reason why there is such a huge short interest, is that people are looking at this and they're saying, you know, $2.6 billion enterprise value for something that's got $280 million in revenues and profitability and positive free cash flow are nowhere in sight. And the thing is, this was a really interesting and exciting story at first, but I kind of feel like the bloom is off the rose on this. You know, people are they're not as enthusiastic, frankly, about getting synthetic meat products. You know, first it seemed like, oh, this is an environmentally friendly and maybe healthier option. And then people start looking at stuff like this and they start saying, well, wait a minute, you know, lab meat? And then you've got people like Guy Adami saying, you know, I tried one of these things, like he tried the Impossible Burger or something else, and, you know, he was complaining that it gave him stomach troubles. Yeah, it just gets people a little uneasy. There's a long way to go, I think, before we really say, okay, yeah, this is going to be a thing. I'm not entirely sure that that's true. So if you're playing in here, you're playing just because this is whipping around. That's it. You want to sell some puts in this thing or do it synthetically, which is what you're proposing. That's fine. But there's not a really good underpinning economic story for this business. There were other companies, similar circumstances. I have a list of them here, actually. I was looking at this. So, for example, here are some other really high short interest names that saw some action. CleanSpark, 21% of the float is short. United States Antimony, UAMY, Plug Power. Yeah, that one has 15% short, but Plug, that's 33% short interest. That thing's whipping around. Clover Health Investments, another one. Hertz, 48% of the float. Donut, which is Krispy Kreme, DNUT. Similar circumstance here. I mean, look at this thing. Traded almost 200,000 calls. Typically trades 5,600. And again, it's one of these really high short interest stories. 32% of the float is short. That one's got a pretty wild ride. So this thing was trading 320 and then traded up to 511 today. You got stocks that are moving more than 50% in just a couple trading days, all on this basis right here, which is the short interest, right? So not quite the same story as Beyond, but it's up there, right? So this is a high. This is a crowded short, real squeeze risk. In Beyond's case, it's in a squeeze, right? So, am I going to recommend that people play in here? I can't do that and feel good about it, but yeah, I mean, one of the things I will say is that because the high borrow cost is there, you can kind of look to local lows, recent lows, and say, what's the chances that the stock really declines below this? Not great. And that's just because of the short interest. I mean, it really does create a little bit of a floor. Finwest says, I haven't seen you use unusual whales much. Is it still a part of your research toolkit? It is. Admittedly, I haven't queued it up as much lately, and I will get back to using it in future episodes. Part of this is just because I have a lot of things that have been running on this machine, and you load up too many browser windows, too many spreadsheets that are getting pulled on the data here, and I just started noticing that a lot of things were getting laggy, and I just had a bad habit. I would look at my Chrome, and I would say, my God, I have 15 tabs open, and it definitely was testing this. So in future, what I'll do is I will queue that up. I'll just restart the machine before we do the next live stream, and that way I know that I'm not taxing it too much. But that's the basic reason. I think Unusual Whales is great. I love the way they visualize implied versus historical moves. I think they do it better than anybody I've seen. So I definitely think that's something pretty strong about it. Steve Garcia says, do you think Bitcoin will continue to outperform the S&P for the next 10 years? What do you think is the single biggest risk to Bitcoin? Would it be over-regulation? Well, I mean, regulation suggests adoption, unless they're regulating it in such a way that they say you're not allowed to use it. To me, the biggest risk is not broader adoption. Broader adoption creates support for it, in my view. I've said this before. I'm a little bit concerned about quantum. I think for most, cybersecurity issues, quantum is one of the risks that people look to and say, what breaks in this environment once quantum computing becomes a reality, because it kind of it breaks a lot of the approaches and techniques for security, and that would be worrisome. Adoption is not a worrisome thing where Bitcoin is concerned for me. So short version is, yeah, I still like it. I still think it's serving a really valuable purpose. Quantum, when I was at that Crossroads Summit in Miami, whenever that was, about a year ago or so, the more optimistic forecasts for when we might actually see quantum computing sort of getting on the scene and being really usable was end of the decade. So 2029-ish, 2030. There was some concern that maybe China is further along the path on this than some think. They were discussing a city in China that is specifically dedicated to this, and whose scientists frequently communicated with computer scientists in the West up until relatively recently. And remember that I was hearing this about a year ago, so they were talking about everybody going all quiet in April of 2024-ish. Does that mean that they were getting close or closer? I don't know. But that is an area where I continue to have some concerns. I think that's imagine the day that they find it usable and you have an unfriendly government that has access to that. That's not a reassuring circumstance. So number one, it's something we have to do. We have to focus on this. We can't lose that battle. Just for reasons of national security, we can't. And that, I think, is the unknown. And there are probably some of you watching, or there may be others who have better insights on to how to mitigate those risks than I have. But regulation is not my biggest concern where Bitcoin is concerned. Okay, let's see. So Deepak says, thoughts on the last 3-month total return of Alti being minus 1% while SPY returned 7%. Well, let's look at it this way. Let's get some price in here. Okay. Put that over there. And this over here. So we'll go back to 07, 22, 2025. Yeah, it's down actually, reinvested. It's about, yeah, so I see, take the distributions in cash, total return is minus 40 basis points. Almost 1% if you had just reinvested it. You know, what is going on when that happens? Well, what that basically is telling you is that being short vol didn't work out so hot. And I think part of the reason that hasn't really worked out so hot is because we did get a bit of an uptick. You know, vol, basically, you know, you're selling vol in here, and vol has gone slightly higher, right? So I don't want that in there. You know, this is the kind of thing that you will see circumstances like this where if you get some really big gaps one way or the other, you could potentially see some underperformance. There is also the issue of what's in Alti. Now, Alti does change its holdings pretty often. You know, let's just take a quick peek at what's in there right now. So we have Palantir. You know, what are some of the biggest holdings in market capitalization? Rocket Lab, Palantir, Robinhood, NewScale Power, and Coinbase. I mentioned, you know, NewScale Power. Those of you who are watching and in constructing portfolios on your own, what have I said about SMR? You know, you can't speak to me right now, but you can put it into the chat. I'm sure some of you will remember that I have a different way to play that, and that is FLR, FLR, because they have a big piece of this anyway, and because whether NewScale proves to be a success or not, FLR is in that space because you know, their construction, procurement, engineering, and they're active in the nuclear generation space, commissioning, recommissioning, decommissioning nuclear power plants. So even if the small modular reactors don't end up succeeding, because they own a big chunk of this anyway, you kind of get exposure, assuming that you think nuclear is a part of the energy equation in future years, which I do. Okay. So Tucker D Dog says scientists were either getting close or not close enough. So in the former case, they were told to shut up, and in the latter, they were just shut up permanently. Yeah, I mean, such is the case when you have a place like China. You know, we don't know why things suddenly go quiet. You know, just like we didn't know where Jack Ma went when he suddenly disappeared several years ago and came back chastened. It is, you know, it's a command economy. It's an authoritarian regime. You don't want to upset them. They're probably pretty good at keeping secrets. And so you're right. They could be all quiet because they're close. Or they could be all quiet because they're not close. We don't know. But it's interesting, right? It is interesting that you have these computer scientists that were communicating regularly with computer scientists in the West, and suddenly they're not doing it. You know, why is that? Don't know. All right. So Yeah, these, I mean, I used to, but most of your questions are about the yield max funds, which is understandable. I mean, I'm associated with yield max, but I don't want to get too distracted for the people who are tuning into this all the time, who are just looking for broad strategy. You know, one quick point I do want to make is that when I speak about these funds, these are securities. So anything I say about them is not a solicitation to buy or sell those securities. Because of my association with them, you know, that creates regulatory issues. So I'm not trying to sell anybody anything. What I will say is I would suggest, if these are strategies that are of interest to you and you do not do what a lot of the viewers of this channel do, which is trade options yourself to do that, but you're trying to buy a product that does that for you, which is what YieldMax does, then take a look at just take a look at, there's a lot of them. There's 55 different funds there. Look at the one that has the characteristics that most appeal to you, that is consistent with your belief about the underlying assets. Fiat or Winter and Misty all have different views. So whether you're long crypto or short it, there's a way to play it. You want to play in that space. There's LFGY. We'll just go in there and just take a look at some of those things. Here's a list of the stocks that are in that space. So you have to make the determination for yourself whether you want to be long or short the theme or the stock, and then see whether you're comfortable with the sort of total return profile in as much as it adheres to your thesis about the price action of the underlying asset. For my recommendation to everybody watching who says, I want to sell premium when it's elevated, not all the time, then you're going to want to just follow the implied volatility and take advantage of that. Everybody who's watching also knows that I look at the longer term trend lines. I look at the fundamentals for the underlying. I look at the mean volatility and how close or far we are from it. And I look for situations where if you can sell longer dated vol, where you think there's going to be a vol crush, so you're getting theta and a vol crush out 45, 60 days, that is something that will smooth those results out. Now, you will not be able to put that money in your pocket every single week, though. All right, so you're squeezing the balloon, as I often like to say. You have to decide for yourself which things are going to be more important to you. Are you looking for weekly distributions and you have to sell weekly options to do that? You're going to get more choppiness. It's as simple as that. And if the underlying asset does, behave itself, you can also see higher rates of return, total return in those strategies, but you will not if the underlying assets become highly volatile. You're selling volatility. So if you think about it this way, whenever you sell options, what you're doing is you're betting that volatility is going to be somewhat more compressed because you're selling insurance, but you're paying out whatever volatility actually is experienced. And that's why it's going to make a difference. One of the things that I think I've mentioned this before, Bruno Dupiere is the chief quant at Bloomberg. He often made an observation that in the longer run, oftentimes volatility looked at week to week or month to month was indeed more compressed than it was looking at shorter windows, right? So I would just urge people to consider or think about that. And look at this. We managed to fill up the full hour. I was not cut short the way I was on Monday. And these are good questions. I welcome them with respect to YieldMax. I would also encourage people who are curious about that. You can go to the YieldMax website, or you can join. Wolf Trading has a Spaces that they do every Wednesday. And at that point, you can actually not just type questions into a chat, but you can speak to Josh Canner, Jay Pastricelli when he's on, or Mike Venuto, and a lot of other people in the space that are invested in this and talk about that. again, I'll be happy to address it from time to time here, but I want to make sure that I don't allow that to completely crowd out what I think to be the broader mission, which is just to talk about options and stocks that we like at a broader sense, right? So that's not trying to avoid your questions. I just want to make sure that we keep the conversation as broad as we would like to have it. So for all of you who joined today, thank you very much. Again, sorry that Mondays was cut a little bit short. That will happen sometimes. But please tune in again when we're back here on Monday, 4:15 Eastern Time. Like, subscribe, and if you have a more in-depth question that you want me to get into where I have to research it, instead of putting it into this chat, put it into the comments for the video, because then I can see it later, and if I have some time, maybe I can put some slides and things like that together. That might be useful for you, and it might be useful for me, and it'll be useful perhaps for other viewers. Thanks for watching.